In finance, we often say, cash is king. You might look at a company's income statement and see a massive profit, but that profit is based on accrual accounting. It includes revenue that hasn't been collected and expenses that haven't been paid. That's why we need the statement of cash flows, governed by IAS 7. This statement is the critical third leg of the financial stool, showing us the actual movement of cash and cash equivalents into and out of the business over a period. It answers the most important question: where did the cash come from, and where did it go? IAS 7 requires all cash movements to be categorized into 3 essential activities. This structure provides clarity and allows users to assess the sources and sustainability of a company's cash flow. Operating activities: this is the cash generated from the principal revenue-producing activities of the entity. Think of cash received from customers and cash paid to suppliers and employees. This section reveals if the core business model is generating cash. Investing activities: these are cash flows related to the acquisition and disposal of long-term assets, such as property, plant, and equipment, PPE, and other investments not included in cash equivalents. Buying a new piece of machinery is a cash outflow, selling an old one is an inflow. Financing activities: these activities result in changes in the size and composition of the equity and borrowings of the entity. This includes getting a loan from the bank, repaying that loan, or paying dividends to shareholders. When reporting the all-important operating activities, IAS 7 gives companies a choice between 2 formats: the direct method and the indirect method. The direct method is simpler. It lists the major classes of gross cash receipts and gross cash payments, like cash received from customers and cash paid to suppliers. It is generally considered more informative, and IAS 7 encourages its use. The indirect method is more common. It starts with net profit from the income statement, and then makes adjustments for non-cash items, like depreciation and amortization, and changes in working capital, like increases in accounts receivable or inventory. This method reconciles accrual profit back to cash flow. To ensure consistency, IAS 7 provides specific rules for complex items: interest paid and received. This can be classified as either operating or financing, investing, depending on the company's policy. However, classifying it as operating is often most common, as it relates to the cost of financing the core business. Dividends received: these are generally classified as operating because they affect net income. Dividends paid: these are classified as financing, as they relate directly to the cost of obtaining or maintaining the company's capital base. Income taxes: cash flows from taxes are generally classified as operating, unless they can be specifically identified with investing or financing activities. Consistency is key. A company must stick to the policy chosen from one period to the next. Finally, IAS 7 requires crucial disclosures. Companies must disclose the components of cash and cash equivalents and present a reconciliation of the opening and closing balances in the statement of cash flows to the amounts reported in the balance sheet. Most importantly, non-cash transactions, like buying a building by issuing shares, must be excluded from the main statement but fully disclosed in the notes, as they affect the company's future financial health. The statement of cash flows is invaluable. It provides a clear, objective measure of liquidity, solvency, and financial flexibility, allowing investors to properly assess the health and sustainability of the business model. It truly is the statement where you find out if a company's profit is backed by real cash. Thank you for watching. Like and subscribe for more similar content.